Amazon has done something unusual 4 times in the last 20 years. It has gone completely sideways for 3, 4, sometimes 5 years, with almost no movement in the stock price. And then, seemingly without warning, it has launched into a multi-year bull market that made anyone who stayed patient look like a genius. The question nobody is asking, is it happening again right now?
Look at this chart. This isn't random noise. It's a pattern. And the recent satellite news, which, most people just dismissed as a distraction, might be the most important signal in that whole answer. Stick with me here because this is where it gets really interesting.
You see, everyone looking at Amazon right now sees the same things. Massive capital expenditure, uncertain returns on all that AI spending, and this new satellite business that's years, maybe even a decade from making a dime. It looks like a capital black hole. But here's the twist. This is exactly what the market said about the logistics build-out back in the 2000s. It's exactly what they said about AWS in 2010. The market has been wrong about Amazon's capital cycles 3 times, and it might just be wrong again.
By the end of this explainer, you're not just going to understand this pattern. You'll be able to recognize it in any company. You'll know the exact metrics to track to see if this current cycle is for real. You'll finally get why return on invested capital matters so much more than earnings per share for these kinds of companies. And you will have a framework for finding the next one before the rest of the market figures it out. Honestly, this is one of my favorite ways to look at a business because it really does change how you see things.
So let's get right into it. Most people think Amazon's biggest strength is growth. It's not. Its biggest strength is how it spends money.
So let's reframe this from the ground up. We are not analyzing a growth stock, we're analyzing a capital allocation machine. It's a system that's designed to do one thing over and over again, just at a larger and larger scale.
And this machine, it has a really simple 4-step rhythm. First, it generates enormous cash flow from its businesses that are already mature. Then, it plows that cash back in, aggressively, to build out the infrastructure for whatever its next big thing is. That investment then builds an absolutely unassailable dominance in that new market. And then, when the time is right, it's like they flip a switch, the profits just explode, and the whole cycle starts over again. This is why the stock goes sideways and then just goes vertical. It's flat for years because the market's waiting for one thing, not growth, but the moment Amazon starts showing obvious profit. And when that moment finally hits, the market re-rates the entire company, fast.
And look, this isn't just a theory. Take a look at 2020. In 2019, Amazon's earnings per share were $1.15. The very next year, driven mostly by AWS, they jumped to $2.09. What happened to the stock? It nearly doubled in months. That's not gradual growth. That is a re-rate. That's the market suddenly waking up and realizing the value that was being built just below the surface all along. So the key is to understand why this happens.
And to really get it, you need to understand 3 specific cycles in Amazon's history, because they all look identical from the outside, and the market got them wrong every single time. We're going to walk through them like chapters of the exact same story.
Let's go back to Cycle 1, e-commerce and logistics. In the early 2000s, Amazon was basically pouring money into a war against physics. It was building warehouses, fulfillment centers, this massive national distribution network completely from scratch. And earnings, they were terrible, consistently. The question on Wall Street wasn't, will it grow? It was, will this company even survive? The market just saw a low-margin retailer burning through cash. But what was actually being built was a logistics network so dominant, with such economies of scale, that no competitor could ever hope to replicate it, not at any price.
And then what happened? Cycle 2, Amazon Web Services, and the market made the exact same mistake, just with a different flavor. At first, everyone dismissed AWS as this little side project, a distraction from the real retail business. Analysts saw a company wandering into a low-margin, super-competitive hardware business. Well, what actually happened? AWS became one of the highest-margin, most profitable software businesses in history. It became the cash engine that funded everything else.
Which brings us to today. Cycle 3. Just look at the list of concerns. Capital spending is too high, the returns on AI are totally uncertain, retail growth is hitting a ceiling, and the new satellite business is just a distraction. Does any of that sound familiar? It's the same script. The company is using the cash from its retail business to fund AWS, and now it's using the cash from AWS to fund AI and satellites. The pattern is identical. The only thing that changes is the asset class.
So, how does this framework actually apply to what's happening right now? Let's talk about the satellites. With that Globalstar deal, Amazon is pushing hard into low Earth orbit connectivity. The market sees another capital-intensive distraction. But when we apply our framework, we don't see it as a new business. We see it as the next iteration of the machine.
And here's the thing. The analysis here is not about trying to calculate satellite revenue in 2035. That's a fool's errand. The real question is not, will satellites be profitable? The real question is, when will the market start to believe they'll be profitable? Because that moment of belief, not the actual profit, is when the re-rate happens. The stock moves on the shift in the story, way before the cash ever hits the income statement.
So how do you track this? Right now, we're in the narrative phase, not the numbers phase. You have to watch for signals that the story's about to change. First, is Amazon getting control of a truly foundational resource? I mean, they went from selling books to providing the digital shells with AWS, and now they're trying to control the pipes that deliver the data. Connectivity is a layer below the cloud. That's an incredibly powerful move. Second, is the CapEx a long-term commitment? If they keep spending at this kind of scale, it's a signal that this is core strategy, not some side experiment. And third, is the cash flow becoming predictable? You look for things like long-term contracts, subscription models, stable usage fees. Those are the little signs that a new durable cash engine is being built.
But this all raises a much bigger question. Why does the market keep making the same mistake? Why does it systematically misprice this company, cycle after cycle? Here's the thing, it's not a mistake. It's by design. The mispricing is built right into the accounting.
Think about it. A normal company builds a factory. It goes on the balance sheet as an asset. Then it gets depreciated slowly over many years. The P&L, the profit and loss statement, looks nice and clean, predictable. But Amazon, it does the exact opposite. When it builds a fulfillment center, it gets recorded as a fulfillment expense, a cost that hits the P&L right now immediately. When it subsidizes Prime memberships, that's an operating expense. This crushes earnings per share, makes margins look razor thin, it makes the company look terrible in the short term. And the purpose is totally strategic. Use difficult-looking financials today to build an unassailable fortress for tomorrow.
And this just perfectly illustrates the core mismatch. The market is playing checkers, asking, how much did you earn this quarter? Amazon is playing chess, asking, can we dominate this entire segment of the value chain in 5 years? And that fundamental difference between their measurement horizon and their investment horizon, that is the mispricing mechanism. And it shows up again with every single capital cycle.
So, now that we understand the why, let's get into the how. How do you actually track this machine and see the business for what it really is, underneath all the noisy accounting? Well, we have to look at its component parts.
Let's start with AWS. The market sees really strong revenue growth, right? But the real story is in the gap between these two numbers. In 2025, revenue grew almost 20%. That's incredible. But the backlog, that's the amount of future revenue they've already sold but haven't delivered yet, grew 38%. When your backlog is growing almost twice as fast as your revenue, that tells you one crucial thing. This business is supply constrained, not demand constrained. They literally cannot build data centers fast enough to meet the demand that is already signed, sealed, and delivered. The runway for growth here is just enormous.
And then let's look at the hidden weapons, advertising and Prime. The market still kind of thinks of Prime as just a shipping program. It's not. It is a subscription to an incredibly high-value ecosystem. And just look at this gap. The annual cost is $139. The approximate value you get back in shipping, streaming, books, all of it is nearly $1,000. That gap, that is massive uncaptured pricing power. And it's exactly why they can raise the price every few years and almost nobody leaves.
Now, all of this, the accounting, the different business units, it can feel complex. I get it. But there is one metric that cuts through all of the noise and tells you if the machine is actually working. And it's not EPS. It's ROCI.
ROIC. It stands for Return on Invested Capital. And in plain English, it just answers a really simple question. For every single dollar the company puts into the business, how many dollars of profit does it eventually generate back? See, it's not about how much you earned in 1 year. It measures the capability of the business to compound capital over the long term.
So this contrast is everything. EPS gives you a result. It's looking in the rearview mirror, telling you what happened last year. ROIC measures a capability. It's looking at the engine, telling you what the business is likely to do in the future. And during these big investment cycles, Amazon intentionally crushes its short-term ROIC. All that CapEx goes in, and it pushes profits down. The market sees that and says, oh, declining capital efficiency. But the reality is future cash flows are being locked in. And when they finally flip that profit switch, ROIC suddenly surges. And that's when the re-rate happens.
But here's the key. The market doesn't re-rate a company just for high ROIC or just for high growth. The real trigger is having both at the same time. You need a rising ROIC, which proves the machine is efficient, and you need present organic growth, which proves there's a huge market to go after. The moment that ROIC starts to inflect upwards while growth is still strong, that is the trigger. Every single major Amazon bull market started at exactly that intersection.
So this brings us to the final takeaway. How can you use this to find the next one? Because the next Amazon won't look like Amazon, but it will share these same structural characteristics. So you look for a dual-layer cash flow, a low-margin business that builds scale and feeds a high-margin platform business on top. You find a company where you think the market is applying the wrong valuation model. You ask if their capital spending is offensive, designed to buy future dominance, or if it's just defensive, just trying to maintain what they have. And finally, you have to question the expenses. Are they just costs, or are they actually investments in building an unassailable long-term moat?
You see, this framework doesn't give you the answer. It gives you the right question. In a world that is obsessed with quarterly earnings, it forces you to look at the long-term capability of a business to compound capital. So the final question isn't really about Amazon, it's about where else this is happening. Where is the market making this exact same mistake right now?
Markets reward the people who do the work before the crowd shows up. You just did the work. See you in the next one.